Good evening from New York. It's 8:05 p.m. on Monday, March 30th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only, does not constitute financial advice. Markets are closed for the evening after a session dominated by the Iran war entering its fifth week and a critical Fed statement. Let's get straight into it.
The numbers tell a story of a market being pulled in two directions. The S&P 500 closed at 6,343, down 39 basis points. The Nasdaq fell harder, down 74 basis points to 20,792. The Dow was the outlier, barely positive, up 12 basis points to 45,219, and that divergence alone tells you this is an energy-driven rotation, not broad buying. The Russell 2000 got hit the hardest, down 1.44% to 2414, which makes sense because small caps have the least pricing power in a supply shock environment. The VIX is at 30.61, still elevated, still signaling caution. The 10-year yield settled at 4.34%, the 2-year at 3.60, giving us a positive spread of 74 basis points, a normally sloped curve, and the advance decline ratio was decisive, 182 advancers against 328 decliners. This is a market where the median stock is under real pressure, even as the headline indices hold relatively contained losses.
The primary catalyst is obvious, oil. But there are at least three stories colliding today. Walk us through them.
The dominant force is the Iran conflict and its direct impact on energy prices. According to CNBC, West Texas Intermediate settled at $102.88, up 3.25% on the day, marking its first close above $100 since July 2022. Brent crude closed at $112.78, up 19 basis points. But the monthly numbers are where it gets staggering. Brent has surged roughly 55% in March, a record monthly gain for the contract dating back to its inception in 1988, surpassing the 46% jump during the first Gulf War in September 1990. WTI is up approximately 53% for the month. The immediate trigger was Trump telling the Financial Times on Sunday that he could take the oil in Iran and potentially seize Karg Island, through which 90% of Iran's oil exports flow. He followed up Monday by threatening to destroy Iran's oil wells, power plants, and the island itself unless the Strait of Hormuz is reopened immediately. The Houthis entered the conflict over the weekend by launching missiles at Israel, opening a second potential choke point at the Bab el-Mandeb Strait. That's the critical escalation risk we need to watch.
And then you had Powell essentially telling markets the Fed won't respond to this shock with higher rates.
Exactly, and that's the second catalyst. Powell spoke at Harvard and explicitly said the Fed's current target of 3.5 to 3.75% is a good place. He laid out the textbook argument for looking through a supply shock. By the time rate hikes would take effect, the oil spike is probably long gone, and you'd be weighing on the economy at exactly the wrong moment. The market reaction was immediate. As recently as Friday morning, according to CNBC, traders were pricing in a better than 50% probability of a quarter-point hike by December. After Powell's remarks, that collapsed to 2.2%. He also cited the 5-year break-even rate at around 2.56% and trending lower over the past 10 days, which is his evidence that inflation expectations remain anchored. This matters enormously because it removes the rate hike tail risk that was hanging over both equity and fixed income markets.
The third story is Micron, down 30% from its earnings report 12 days ago despite a confirmed supply shortage. That's a real puzzle.
Micron fell 11.3% on Monday, and the sympathy damage was severe. Western Digital dropped 11.93%, Sandisk fell 10.92%, Ciena lost 11.2%, Seagate dropped 8.15%, and Corning fell 8.7%. That's 7 of the top 10 losers today, all in technology. The paradox here is that Micron's earnings were genuinely strong. CEO Sanjay Mehrotra told CNBC that key customers are only getting half to two-thirds of their requirements due to the AI memory shortage. But the stock had run up 270% over the prior year, and this is a case where valuation excess meets a risk-off environment. When the VIX is above 30 and oil is above 100, capital rotates away from momentum names regardless of fundamentals. The memory and semiconductor complex has become a source of liquidity for funds that need to de-risk.
Let's connect the cross-asset picture. How is the oil shock flowing through bonds, commodities, and sector rotations simultaneously?
This is where the causal chain gets really important. Start with oil above $100. That flows immediately into jet fuel. According to CNBC, jet fuel prices averaged $4.57 a gallon as of last Friday, up nearly 83% since the day before the war began. JetBlue already announced bag fee increases of $4 to $9, which is the earliest visible pass-through to the U.S. consumer. Then trace the chain further. Oil-derived materials like polypropylene and polyester are feeding into manufactured goods. CNBC reported from a Beijing trade show that Chinese suppliers are already passing through 5 to 20% price hikes on products from pickleball paddles to scarves and toys. A supply chain consultant from Shanghai warned that if this extends into May, there will be triage between industries for oil-related materials. So the chain runs oil spike to input cost inflation across manufacturing, to consumer price increases, to margin compression for consumer discretionary firms, to reduced spending power for households. That's 4 steps ending in a real demand destruction risk.
And yet the bond market is relatively calm. The 10-year at 4.34 isn't screaming panic.
That's the Powell effect. He effectively capped the long end by telling the market the Fed won't respond with rate hikes. The 2-year at 3.60 is sitting right at the Fed funds proxy, confirming the market fully believes the hold. The 74 basis point positive spread on the curve says the market is pricing moderate growth with contained inflation, not a stagflationary blowout, at least not yet. And here's the important nuance. Oil-derived shows what happens when the war hits physical supply. According to CNBC, Iranian drone and missile attacks on Emirates Global Aluminum and Aluminum Bahrain over the weekend sent London Metal Exchange aluminum to $34.92 per ton intraday, up 5.5%, before settling at $33.81, up 3.5%. About 9% of global aluminum supply comes from the Gulf. Macquarie's base case before the attacks assumed a 20% capacity cut, roughly 800 to 900 kilotons of production loss in 2026, which they said was enough to push the global market into a full-year deficit. This is the supply shock narrative metastasizing from oil into industrial metals.
So what does all of this actually mean for the Fed's rate path? Give me the explicit framing.
The 2-year at 3.60% tells you the market expects the Fed to hold at the current 350 to 375 range for the foreseeable future. There is no rate hike premium embedded in the front end of the curve. Powell was crystal clear. He's looking through this supply shock because monetary policy operates with a lag, and tightening now would hit the economy well after the oil disruption has resolved one way or another. The 5-year break-even at 2.56% is his political cover. It shows medium-term inflation expectations haven't de-anchored. Our view is the Fed holds through at least September 2026. The only scenario that changes this is if energy costs stay elevated for multiple quarters and begin contaminating core inflation. And even then, Powell signaled the bar is very high. There's an important secondary wrinkle. Powell's term ends in mid-May, and his nominated successor, Kevin Warsh, has stated a preference for lower rates, so the direction of travel after the transition, if anything, skews dovish, not hawkish.
Let me push back on one thing. Powell also mentioned rising defaults and investor withdrawals in private credit, a $3 trillion sector. Shouldn't that be getting more attention?
It should, and I think it connects directly to the macro story. Powell said he sees a correction going on in private credit with people losing money, but doesn't yet see the contagion linkages to the banking system that would make it systemic. His words were, "I'm reluctant to say anything that suggests that we're dismissive of the risk. That's a careful flag." Private credit has been under stress partly from overexposure to software investments amid AI disruption, which ties right back to the tech sell-off we're watching. If the oil shock persists and dampens economic activity broadly, those private credit portfolios face a double hit: deteriorating fundamentals in their portfolio companies and redemption pressure from investors seeking liquidity. It's not the primary catalyst today, but it's a structural vulnerability that amplifies the risk case.
Who are the clear winners and losers from today?
On the winning side, the cyclical standouts are defensive enterprise software names. ServiceNow gained 6.93%, Workday rose 3.35%, Salesforce added 2.73%. These are companies with recurring revenue, high margins, and minimal exposure to energy input costs. They're where growth investors hide when the commodity complex is on fire. The trade desk bounced 3.77% on oversold conditions. Arthur J. Gallagher, the insurance broker, gained 3.82%. Insurance is a direct beneficiary of geopolitical risk repricing because premiums rise. TKO Group, the sports and entertainment company, added 4.06%, essentially insulated from energy cost pass-through.
Structurally, energy is untouchable. 100% of energy stocks are above both their 50-day and 200-day moving averages, with nearly 82% near their 52-week highs and 0% near lows. That's perfect breadth across a $2.3 trillion sector. Utilities are the second pillar, about 81% above the 50-day, 90% above the 200-day, and 71% near their highs. That's a combination of defensive rotation and rate-sensitive tailwind from Powell's hold stance.
Wait, 7 of the top 10 losers are all technology. That's not a stock-specific story, that's a sector event.
Exactly right. Technology as a sector has only 13% of stocks above their 50-day moving average, 31% above the 200-day, 0% near their highs, and 21% near their 52-week lows. This is an $18.9 trillion sector, the largest in the S&P, and its breadth is approaching capitulation levels. And it's not alone. Financial services, a $7.6 trillion sector, has only 4% of stocks above the 50-day moving average. Consumer cyclical, at $6.3 trillion, has less than 4% above the 50-day, with nearly 23% of stocks near their lows. Industrials, $4.8 trillion, have only 5% above the 50-day. Real estate is the worst on a near-lows basis, with 48% of its stocks near 52-week lows and less than 10% above the 50-day. These are enormous sectors being quietly crushed while the headline index stays within spitting distance of 6,300 because energy and utilities are propping up the cap-weighted average.
Let's talk about the Magnificent Seven because they're a huge part of that technology and consumer cyclical weakness.
Every single one of the Magnificent Seven is trading below its 50-day moving average. NVDA fell 2.18% today to 165.06 and is down 12.53% year-to-date, trading below both its 50-day at 183 and 200-day at 179. Meta Platforms was flat on the day at 536, but is down 17.5% year-to-date, sitting 22% below its 200-day moving average of 685. Tesla dropped 2.89% to 355, down nearly 19% year-to-date. Microsoft fell 86 basis points to 358, down almost 24% year-to-date, and a stunning 25% below its 200-day at 476. Alphabet lost 1.06%, Apple shed 1.38%, Amazon dipped 22 basis points. The group as a whole is in a confirmed downtrend on every time frame from 5 days to 3 months, and the AI narrative that supported these names is being overwhelmed by the geopolitical risk premium repricing the entire equity complex.
What's the risk case investors should be stress testing tonight?
Our base case, which we assign a 55% probability, is that the S&P trades in a range of 6,200 to 6,420 over the next week. The 10-year holds between 420 and 450. WTI oscillates between 95 and 112, Brent between 108 and 120. The Fed holds through at least September. In this scenario, Powell's dovish hold removes the rate hike tail risk and allows equities to stabilize in a wide range, but elevated oil, the VIX above 30, and the negative advanced decline breadth cap any meaningful upside while geopolitical headline risk persists. The risk case, which we assign a 35% probability, is significantly more severe. The trigger would be an escalation to U.S. ground operations on Karg Island, which the Washington Post reported the Pentagon is already preparing for, with 3,500 troops arriving in the region, or a Houthi closure of the Bab el-Mandeb Strait, removing an additional 4 to 5 million barrels per day from global markets. Societe Generale's Michael Hague explicitly told CNBC that if those barrels come offline on top of the existing Hormuz disruption, this leg's oil price is much, much higher. Their published scenario sees Brent at $150 per barrel in April. In that case, we'd expect WTI to reach 125 to 140, Brent to 140 to 150. The S&P would likely target 5850, a roughly 8% drawdown from here. The 10-year yield could spike to 465 as the bond market begins pricing stagflation risk, regardless of what the Fed says. The causal chain runs dual choke point shutdown to crude above 140 to jet fuel doubling again to Chinese manufacturers passing 20% plus price hikes to consumer spending contraction to earnings downgrades across consumer discretionary and industrials. That's a stagflationary shock that compresses margins and spending power simultaneously.
That remaining 10% probability, what does that look like?
That's the upside tail, a rapid de-escalation, a ceasefire agreement, or partial reopening of the Strait of Hormuz. Trump himself mentioned that Iran had allowed up to 20 boats laden with oil through the strait as a sign of respect. If a deal materializes, oil could retrace sharply below 90, the VIX would collapse, and the beaten-down growth names, the Magnificent Seven, memory, semiconductors, would see a violent snapback. Bill Ackman was on this theme over the weekend, calling it one of the best times in a long time to buy quality. That's the counterargument. If the war ends quickly, you're buying an entire equity complex marked down 10 to 25% on what turns out to be a transitory shock.
So how should investors actually position?
Highest conviction, energy producers maintain or increase immediately. The sector has perfect breadth and is the only direct beneficiary of the primary macro driver. Secondary conviction, utilities maintain structurally. They offer the defensive characteristics and rate-sensitive tailwind that this environment demands. Tactical, enterprise software names like ServiceNow and Salesforce are functioning as a growth hedge, recurring revenue, no commodity input exposure, benefiting from the AI build-out regardless of oil prices. For hedging, if the VIX pulls back toward 25 on any de-escalation headline, that's an opportunity to buy put spreads on the NASDAQ as insurance against the risk case. Avoid consumer discretionary broadly, which has less than 4% of its stocks above its 50-day average and is directly in the path of the energy cost pass-through. Avoid rate-sensitive real estate, which has nearly half its stocks near 52-week lows, and be very cautious with the memory and semiconductor complex. Despite strong fundamentals, these names are acting as sources of liquidity in a de-risking environment and could see further forced selling.
How does it all fit together?
When you step back, this is really about a market trying to price a geopolitical supply shock while the central bank explicitly refuses to respond with tighter policy. That creates a bifurcated environment. Energy and defensive sectors thrive because the supply constraint directly benefits them, and Powell's hold protects their rate-sensitive valuations, while growth and cyclical sectors suffer because the commodity shock compresses margins and consumer spending power without any offsetting monetary relief. The aluminum story, Iranian attacks on Gulf smelters putting 9% of global supply at risk, shows this conflict is no longer just about oil. It's spreading into industrial metals, into manufactured goods pricing through the Chinese supply chain, and into consumer-facing costs like airfares and checked bag fees. The entire transmission mechanism from geopolitical conflict to household wallet is now visible and accelerating.
The counter-argument deserves genuine consideration. If you believe Trump's statements about progress in negotiations, that Iran has agreed to most of the 15 points, that indirect talks via Pakistani emissaries are going well, then this entire risk premium unwinds rapidly. Tyler Broodspeed, the former White House Counsel of Economic Advisors, now at ExxonMobil, made the broader structural point in his new book today. Economies have been getting better at absorbing the kinds of shocks that historically would have generated recessions. If the war ends quickly, you're looking at deeply discounted quality assets, the Magnificent Seven trading 10 to 25% below their 200-day averages, in an economy where the Fed is holding rates steady and AI capital spending remains robust.
Give us 3 takeaways to close. First, risk management. The 35% probability we assign to a dual choke point escalation, Hormuz plus Bab el-Mandeb, is unusually high for a tail scenario, and the impact would be severe enough to push the S&P toward 5850 and Brent toward 150. Portfolio insurance is cheap relative to the magnitude of that downside. Second, market insight. The sector breadth data is screaming a message that the headline indices are masking. Technology at 13% above its 50-day, financial services at 4%, consumer cyclical below 4%. These are multi-trillion-dollar sectors in genuine distress, and the only reason the S&P is holding 6,300 is because energy and utilities are carrying the cap-weighted average. Third, positioning. This is a barbell environment. Own the commodity beneficiaries and the defensive yield plays on one end, own high-quality enterprise software on the other, and stay disciplined about avoiding the sectors caught in the middle, consumer discretionary, industrials, and rate-sensitive real estate, until we get either a ceasefire or a clear repricing of the growth outlook.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.